Welcome to RBC's Markets in Motion podcast, recorded May 5th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, it was another week of stabilization on the earnings stats we track, helping to support the recent stabilization in equity market pricing. Second, there was a little less conversation about tariffs in last week's earnings calls, which left some additional room for discussions on the health of the consumer and the impacts of non-tariff policy changes. Third, in our other weekly updates, the thing that jumped out the most is that when we bake in current consensus assumptions on key macro variables and bottom-up EPS for 2025, the S&P ended the week roughly in line with where our model says fair value should be for the S&P 500 at year-end based on a moderately stagflationary forecast. If you'd like to hear more, here's another 7 minutes. While you're waiting, a quick note that in about a month, voting in the 2025 Extel Institutional Investor All-America Research Survey will be opening up. If you found this podcast helpful, we'd appreciate your support in the portfolio strategy category again this year. Last year, we were honored to come in number 3. Let's get into it and start with takeaway number 1. It was another week of stabilization on the earnings stats. The bottom-up consensus S&P 500 EPS forecast for 2025 inched up to just under 266. Meanwhile, earnings sentiment, the percent of sell-side EPS estimate revisions to the upside, also inched up to 30% from 28. The prior 28% level is about as low as this indicator tends to go outside of things like COVID, the GFC, and the tech bubble. Interestingly, both the top 10 names and the rest of the market have fallen to levels that typically mark their low point on this rate of revisions indicator, another piece of evidence arguing that the recent stabilization in U.S. equity prices is supported by fundamentals and that pessimism on the biggest market cap names may have run its course for now. We are still seeing companies that beat consensus earnings forecasts outperform the broader market in terms of immediate stock price reaction. The margin of outperformance has been wider than usual, suggesting to us that earnings dynamics, not just the apparent pivot on trade, have been pushing the U.S. equity market higher. That being said, this phenomenon does appear to be losing some intensity since mid-April, suggesting to us that the U.S. equity market may soon demand another catalyst to keep the recovery going. Let's move to takeaway number 2. There was more room for consumer and non-tariff policy discussions on last week's earnings calls. Here are some key themes based on our readings of what we read last week for the S&P 500. On the overall macro, comments seemed more skewed to those with a negative bias. Those with more of a positive bias emphasized the lack of change in customer behavior, stable demand, efficiencies, the idea the U.S. will avoid a recession, manageable tariff impacts, and being on track for current guidance despite tariffs. Outlook comments with more of a negative tone emphasized tumultuous news flow, weaker trends in February, March, and/or April, cautious customers, a lack of Fed cuts, a slowdown in decision-making, and high uncertainty. We got much more color on the consumer last week from restaurants, food companies, cruise lines, casinos, credit card companies, and travel-related names. Positive comments tended to emphasize stable operating and spending metrics and low delinquencies, with some emphasizing they'd seen no change in behavior. Like broader outlook discussions, we found more comments with a negative vibe, which tended to emphasize the adverse impact of lower consumer confidence levels on demand or their potential to have an adverse impact, pressures specifically on snacking and smoking, low income weakness, a decline in length of stay for trips or shorter lead times for bookings, softer DIY purchases, and the idea that consumer pressures predated tariffs. In general, what we're seeing in this reporting season is that companies are take a higher level look at the consumer are saying things are just fine, while those with a closer vantage point sound a bit more worried. On tariffs, we didn't learn too much in the way of new information after last week's avalanche of industrial earnings. With a heavier dose of tech companies taking the spotlight from the industrial sector, the tariff discussions overall seemed a bit less front and center as well. Positive comments on tariffs tended to emphasize mitigation strategies, footprint adjustments either in the future or the past, pricing, USMCA compliance, and ability to manage through. Negative comments tended to center on the fluidity of the policy backdrop, heightened uncertainty, and difficulty in knowing where the policy will settle. We don't have a great feel for the exact contours at the moment, but we have been paying close attention to discussions on the timing of impacts for when mitigation strategies go into effect or stop having an impact. We've also been paying close attention to whether the companies are talking about a pull forward of demand, a pause in demand indecisions, or delays. And for now, unfortunately, the discussion still seems to be that all of the above are happening. Sequencing and timing are likely to be in focus in the next reporting season. There did seem to be more airtime available for non-tariff policy discussions on last week's earnings calls, at least based on what we read. Once again, the tone on this topic was mixed. Negative comments tended to coalesce around the impacts of spending cuts, i.e. DOGE, NIH, and academic institution-related pressures. Positive comments tended to center on tax and regulation. FX discussions once again stood out in our reading, with a number of companies in different industries saying the weaker U.S. dollar of late helped mitigate some of the pressures that had been in place from a stronger dollar previously. As noted last week, what we've read in reporting season keeps us in the camp that recession is not a foregone conclusion, but also adds to our concerns that investors had gotten too worried about the near term, but perhaps not worried enough about the intermediate to longer term. We've also argued there are two different perspectives of the consumer at play, which have added to investor confusion, and we've noted that managing tariff impacts appears to be a work in progress, but that corporates have generally done a very good job of articulating the work that's been done already and of reminding investors that they're skilled at managing through periods of challenge. We'd add now that we expect the next reporting season for calendar 2Q25, which will take place from mid-July to mid-August, to be a time in which we simply gain a much better understanding on how all of these issues are evolving, as well as the real path that trade and tax policy are on. We'll wrap up quickly with takeaway number 3, the other big thing that jumped out in our updates last week. This one relates to our valuation model, which comes up with a fair value estimate for the S&P 500 at the end of the calendar year based on macro assumptions on inflation, 10-year yields, and the Fed, along with various EPS assumptions. The specific scenario that bakes in the current consensus on bottom-up EPS forecast for the S&P 500 in 2025 of 266, and the latest year-end 2025 consensus assumptions on inflation, just over 3%, the Fed for a few cuts, and 10-year yields slightly north of 4%, point to a year-end 2025 fair value level of 56.28 for the S&P 500, essentially in line with the levels that we saw at the end of last week. The consensus is a bit more optimistic on inflation and economic growth than the assumptions that go into our own year-end forecast of 55.50, but we found this output interesting nonetheless, as we think it suggests the U.S. equity market is baking in a very moderate stagflationary backdrop at current levels. We think the recent rebound has been reasonable on that basis, though in our view, equity market pricing is likely to stay very reactive to any new shifts and assumptions about the macro backdrop in the months ahead. That's all for now. Thanks for listening, and please reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.